All right. All right. Let's get it going. So, hey, welcome back to the High Podcast. We officially got the name for this podcast. It is High Podcast. It's an acronym for hobbyistic investor. And pretty much this is the podcast. And I'm going to introduce some co-hosts to this channel. My name is Ronald. I'm the host of this podcast. And I want to introduce to you Travis Escuffery and Romaine Benjamin. These are both engineers. We got introduced to Romaine last podcast. I'm very happy to introduce Travis on here as well. How's it going, guys?
Oh, well, how are
Feels
you?
good to be here.
Nice.
Thanks for having us on.
Yeah, man. Yeah, I mean, this
And I guess as a co-host, I'm going to be bothering you month to month. This is going to be good. Not Rocky though. Rocky's ready for all the nonsense.
Exactly. So yeah, no, it's gonna be great, guys. Keeping this cadence going on. Making this podcast come out every single month. So yeah, it's gonna be really nice. We're gonna have different topics to discuss. We're gonna have awesome discussions and hopefully, get a lot of great insights into what we're gonna make our decisions and our goals in our overall endeavors for real estate. So let's see. Let's get into today's topic of today. We're gonna be talking about real estate investing strategies. So, live and flip, we got buy and hold, we got fix and flip, and we also have bird. And see if we can get into some other ones as well. But pretty much want to get into the pros and cons of each one of these. And yeah, let's get that going. All right. I want you guys to tell me like what's one that you want to start off with.
I think we should probably go from worst to best, right? To make sure people stick around to the end.
Worst to best.
or
Okay.
actually to make sure it's not subjective, right? Like the things that are furthest away from what works for us to the things that are closest to what works for us. How about that?
Yeah, sounds good. Well, how about let's see. Let's say which real estate strategy are you guys going with right now? I can start off really quick. I'm more of a live and flip person, so that's my strategy right now. So, what about you, Travis?
Definitely live and flip, and a little bit of buy and hold.
Cool. What about you, Romaine?
I have done a fix and flip, and I'm primarily a buy and hold.
Cool. All right. Cool. So I don't know. It seems like in between live and flip and like I haven't did a fix and flip because I'm mainly in the sense of like renovating as I'm living here kind of thing. So yeah, let's start off with live and flip since I think we all have similarities and some things in regards to that. So yeah, what's some pros for live and flip?
I'll jump in. I think one of the big pros for me is just the price point. The barrier to entry for live and flip is so much lower. Having the opportunity to not have to put that 20% down means that I have a lot more flexibility in where I can look. I have a lot more flexibility in how I can invest in the property once I get it. And it really makes it so that the actual investment portion feels a lot more attainable for someone like me.
True. What about you, Romaine?
So maybe you didn't hear me that well. I said I've done a fix and flip. I've never done a live and flip. So I'm actually here to learn from you guys, more so on the live and flip. But I can imagine the pro that Travis just mentioned. But yeah, I pass it to you, Ron, since you have more experience on it.
All right. So just like you said, Travis, I'm sorry about you saying that you say you're fixing flip. So for some reason I thought you did a live and flip before, but all right. But it's all good. So I think pros is one barrier of entry. So minimal down payment. So I don't have to put down 20% to get into a house. And I could just put down maybe, 3.5% if I'm doing an FHA loan, or, at minimum 6% if I'm doing a conventional loan. I can definitely put down higher if I want to, if I'm thinking about cash flow in the long run.
I actually want to make sure we take a step back and just define the terms themselves as well. So for live and flip, it's treating the investment property as your primary residence. So you'll be purchasing the property, and you'll be moving in, and you'd live in it for some amount of time. It's typically a year. And during that time, you're pretty much either going to invest in it to make it to increase the value of the home, or you're not going to touch any parts of it so that you don't decrease the value of the home, right? So you're primarily going in it and looking at it as, this is my investment. I'm only staying here so that I can take advantage of the fact that I can be treated like a first-time homeowner. And that's where that FHA loan comes into play that you mentioned, Ron. And if you wanted to do a conventional loan, essentially the price points are a lot smaller. And for those that are listening, going into the investment space, a lot of times, or at least for me, what I heard, I needed to figure out how to get 20% to put down on a home. And that immediately took me out of the game for anything over $450,000, right? For right now. So I think a huge bonus of the live and flip is you get in at 3 to 6%, right?
Mm-hmm.
But now that plays into one of the cons that I'm going to get into. But I just want to make sure we define that term, and I want to try and do the same thing for the other terms, so that our listeners know what we're talking about.
That's really good.
So on behalf of the audience and myself, because I have this question, when you were defining a live and flip, you said typically a year. Why is a year typical? Why not 2? Why not 5?
Yeah, that's a great question. I think. So it's interesting that you went up, right? You went 2 years or 5 years. I would have assumed you would have asked, why not 6 months? So interestingly enough, it has to do with taxes. So if you could, for everyone listening, you could actually purchase a home and immediately sell it right after you get the keys, right? As far as a rental is concerned, you have to think about insurance, and you have to think about taxes, because your insurance and taxes change when you go from being the person that lives in the property to a landlord. So the conventional time of a year is to basically avoid any taxes that you might incur from transitioning it to an investment property from actually being your primary residence. Now, the question of why not 2, why not 5, that's really taste. That's subjective. That's actually another thing that I'm going to hit on in my cons, but I want to give Ron an opportunity to kind of comment on that if he has anything to say.
So, yeah, actually, I have a good reason why, I would stay in that property. Oh, no, I'm jittering over here. What is going on? This is not me. What's going on?
His true self he has showed his true self.
I was like, what's going on?
You ask Ron about taxes and he starts getting shifty.
Okay. So to the taxes point, right? All right. So I actually would stay in the property a minimum of 2 years. And the reason behind that, there's a tax benefit behind that. So if you do want to sell that house, you can sell that house after 2 years, and then any capital gains that you have within that 2 year standpoint, essentially, depending on if you're married or you're single, is $250K tax write-off from the capital gains that you get it. And if you're married, it's $500K if you're married, and it probably changed, but is a tax law out there for IRS. If you stay in a property for two of the first 5 years of owning that property, pretty much the capital gains is wiped out from that amount. And that's really great because, essentially it's tax-free money that you're getting that you can pretty much invest into something else if you do decide to sell that place.
From personal experience. So I guess in a way you could consider it a live and flip, but I wasn't really trying to. I lived in a property for 5 years and moved, and I did not incur any additional capital gains tax because I was in there for at least 2 years, like you said. Um, and praise God, the value of the home increased substantially, to where in a way you could say it was a flip. I mean, because I got more money selling it than I did having to purchase it just by living in it for 5 years.
And that's the beauty of appreciation. And
Mhm.
plus you did a fix with it as well. So you add value to the property as you were staying there. So that was awesome.
I mean, we tore it up, but we painted it. It cost me $5,000 to repaint all the stuff my kids tore up. All the paint handprints and scratches and all that stuff. But still, the appreciation outshined the cost to fix it up for sale. So that was still a blessing.
No. So I was wondering if we had any more pros. Other than, I have a little story behind it. And the reason why I actually start, wanting to live in a house and move away from renting and all this other stuff. It's just from a sense of security. I was in a financial good. Luckily, I was in a financial situation where I can buy a house. One, two. The reason why I feel like it's beneficial for me, I don't have to worry about getting kicked out or saying that, hey, you need to move at this particular point after your lease is up. I mean, you definitely have some landlords that are very shifty and, not thinking about that kind of thing. It could have been terms where I could have, stayed in the place and I could have paid more rent, but they wanted to be doing shifty stuff during the time when the market was going substantially up. And I had to essentially move my family out before I actually secured a house. So I moved into an apartment while I was waiting for my house to get built.
That's tough. I'm sorry.
Yeah. Yeah, no, it's all good, man. So, I made things happen. Like I don't look at the hard pieces of it and say I'm stuck. I'm always continue to move and continue to make things happen.
Right. Now, what I will plug is, I want to make sure we differentiate like moving from being a renter yourself to being a homeowner, and then moving from being a homeowner and you want to get into investment, getting houses that are investments. If you're already a homeowner, you have a lot of tools at your disposal, and when you decide to expand your portfolio by getting another house, taking advantage of being a first-time homeowner is a big boon, right? Because you're now in a situation where if you have the capital, you get in on a very low price point. And Ron, you knew what was happening in 2020 in the housing market, 2020 and 2021 in Austin. It was ridiculous. I actually have a story as well. The move. My wife and I started in Round Rock, which is it's a suburb right outside of Austin. And when we made a decision that we wanted to get into investment housing, we decided to actually move to Manor. And when we moved to Manor and we were going to rent out the house in Round Rock, as far as the numbers are concerned, it was probably one of the best decisions that we could have made, right? The house itself was going to make cash flow just based off of the fact that the housing market in Austin was accelerating so quickly. But also the Manor area was still in development, and the Tesla Gigafactory was still being built. So while there were a lot of very aggressive investors coming into the area, there are still open lots that we could take advantage of. And the assessment for the property was gonna happen at the beginning of the new fiscal year, right? So essentially, we were able to come in, make the decision that we wanted to shift over to an investment property, buy in on a contract, which I don't know if you've talked about contracts up to this point yet, but for anyone listening, a contract is essentially the builder wants to start selling lots before they actually break ground. So they're going to go out to a bunch of people and say, hey, do you want to take advantage of this lot that I have, and essentially build later. And it's a commitment that you're going to build on the lot. And it's about $1,000 or it's $1,000 to $2,000 to get your contract. And this is 18 months ahead, right? So we made a decision in November of 2020 to take on this investment. We signed the contract in the third week of December, and I kid you not, 3 days later, there was an assessment done on the entire neighborhood that we were going to build in, and our house's value, without us doing anything, jumped by $15,000, right? And then as we were going through the building process to put anything on the lot, the huge spike that was happening in Austin really started to roll. So the house's value, I don't know if we're comfortable sharing numbers on the podcast, but we went in, we took out a loan for $330,000, and the house's value on Zillow, right when the house was built, was $450,000.
Nice.
So, just from us making the decision to sign a contract to look at new builds, to look in Manor because we knew that it was going to develop because there were other communities that were building around it. There was a really nice tech facility that was being built, and the Gigafactory was being built down the street. We saw it as a kind of a no-brainer, and then the timing just worked out really well. Now that does get me into the con. We had to move to Manor, right? And that was just something that we had to deal with. It's just, it wasn't, I don't want to badmouth Manor. Manor's a great area. It's just something that for us, where we were in our life, we knew that we didn't want to be in Manor for an extended period of time. And what that does is it starts to move you from an objective thought process or line of thinking to a subjective line of thinking. So the folks that are listening, the reason why you make investments, at least in this realm, is for the long-term gains that you're going to have, right? At least for the live and flip and the buy and hold. Those are long-term plays. So if you start having a subjective mindset early on, you might make financial decisions that don't correspond to your goals. And we saw ourselves starting to shift into making those types of decisions. So we knew it was a time for us to go back to our Round Rock house so we can continue on our vision from a place of feeling grounded.
No, that's great. Yeah, I'd love to hear that, man. Yeah, that's fantastic numbers and nice ROI, like fantastic. Like, and I say I had somewhat of a similar situation here. Is like, moving out here in Texas as well, and near the Austin area, and essentially, yeah, I had that spike as well. I mean, right now, I have to look into the numbers, but the last time I checked on, it was either Credit Karma or one of those as home estimates, and right now it's at 88K for the valuation for this place. So, whenever the time does come, either I sell or, do a cash out refinance if it makes sense and the numbers do right. Yeah, it's a thing of beauty, and I'm definitely going to try to move away from that subjective thing on how I feel, because I was kind of explaining to you before we started this podcast is that one property that we analyzed last week in Seguin is like, it fitted all the numbers. I would get like a really decent rate for what I was going to get, and it was going to cash flow, and I didn't have to stay in that place. And, objectively, like looking at that, and I think it would be a really great thing. I don't have to stay there for I don't have to stay there for a whole year. I can probably just stay there for a year. But just that mindset, I need to definitely think about that for sure. And the family too. Gotta make sure the family is all right with it too. They might be more subjective than I am. But yeah, so cons. So you get into the cons of this live and flip thing. So what is the cons? Like, you kind of discussed some pieces of it, but what do you guys think?
I think the con is if you lived in a place before, or one of the cons, if you live in a place before and you really like that place, you're moving out of your house that brings you comfort to go to a place specifically for the investment benefit and you're putting the house that provided you comfort on the market for other people to live in, right? And there's just a tremendous amount of risk, and there's a tremendous amount of attachment to it. So you could spend money every month to pay a property manager, to pay contractors, and so on, to make sure that they take care of your house. But now that's cutting into your numbers for whether or not you're going to actually make cash flow or break even, right? So I'm going to continue down the path of it. There are a lot of subjective decisions that you start to make, right? Like, are these tenants going to take care of this house that I really love? Is this property manager going to respond as quickly as I need them to respond if something's broken? Is this something that I want to manage myself, right? Like, all of those decisions should be based off of the numbers, but because you're leaving a place that you probably have put roots down in, you're probably going to start making decisions based on how you feel.
True. Very much true. I'm definitely feeling comfortable here.
Yeah. How would you want to rent out your house, the house that you're in right now? How would you want to rent that out to a stranger with a question mark for kids and question mark for pets?
Oh yeah, exactly. Yeah, I would say this is probably the most decorated I ever put anything. Like, I never decorate anything because my whole mindset is that I don't need as much stuff. I want to be as light as possible. So I want to be able to move. And this is the most stuff I ever had, like, in my room ever. So, but I do want to know your opinion on this, Rocky. So, like, what are your thoughts on that piece, or do you have anything else to add to that?
I would say you guys pretty much covered what my understanding of the pros and cons of live and flips are. You have to be willing to move. If you don't want to be taxed substantially by the sale of the property that you have moved into, then you want to be in there at least 2 years. One thing that I think is worth noting again for those who are starting out, if you have been renting, I forgot what the rule is. It might be that you haven't owned a home for at least 6 years or something like that. But there's a rule that defines whether or not you are a first-time home buyer. And even if you've owned a home in the past, there's a duration that I can't remember off the top of my head, that if you haven't owned a home for that amount of time, you can then qualify for the things like FHA and other loan products that are specific to first-time home buyers. But even if you're not a first-time home buyer, and you want to purchase a property using the live and flip strategy, you can still get typically better loan products or a better down payment or a lower down payment than someone who's treating it as an investment property that they're not going to be staying in, that's treating it like it's a standalone business. So even if you're not getting an FHA loan, you may be able to get a conventional loan that's like 5% down or 3.5% down, all depending on credit score, the lender you're working with, and what have you. And then everyone knows other things about moving that you may not like is, things get broken in transit. Someone don't carry your TV the way you like it. And then when you have a larger family, like I have 4 kids and a wife, transition becomes more difficult.
Facts. I don't really care if things get broken. I want to break everything. I want to get rid of as much as things as possible. So I don't even care if my things get broken. I'm like, I'll just replace it when I need to.
So you can see all my decorations behind me, right? and how they're not attached to the wall. So there was an anime I watched growing up called Darker Than Black, and there was an assassin where his landlord saw his apartment and all it had was an air mattress on the floor. And he's like, "Where's all your stuff?" He's like, "Why do I need stuff? I come home to sleep." And it stuck with me.
Oh man.
Because like Travis was saying, if we want to decide later that this property appreciated by 70% and we want to get rid of it, I don't want to have so much stuff weigh me down to make it harder to make the right decision for my family financially. So that's part of why I've every time I've moved, I've minimized how much stuff I have.
It's a good approach.
I'm trying to get there. I'm trying to get there.
I have attachment issues. I'm not there yet.
I see. I don't have attachment issues. It's my kids, my wife. They're attached to everything. So yeah, it's hard.
Um, so looking at the other strategies, I'm definitely interested in hearing what you would consider a pro, or what you would consider a high ranking strategy, Rocky, and like what are the pros of that strategy? Because we just talked a bunch about live and flip.
You said what I would consider a high ranking strategy.
Like, yeah, what works? What do you, for you? What works the best, and why?
So to super generalize the two remaining strategies on our agenda, I would say fix and flip is great for building capital fast. Buy and hold is for building wealth, much more wealth in the long term. Some of the cons, so for fix and flip, it's like a job. Once you fix and flip the property, your capital increases stop until you find the next one. The barriers to entry with the fix and flip would be making sure you have enough leads so that people think of you when they're trying to sell their dilapidated properties. Having a lot of connections with wholesalers. For those who don't know what wholesalers are, they're typically people. It's one way you can invest in real estate, by finding someone who's a motivated seller, someone who had a death in the family and they got the house, but they don't want it for whatever reason. They don't even want to clean it up, right? Or someone had a bad divorce, or someone got a great promotion and they want to leave immediately and they don't want to go through all the hoops to go through a realtor or whatever. So they go to a wholesaler who says, I buy ugly houses on a billboard, and the wholesaler says, okay, I have this distribution of real estate investors who may be interested in your property. So if you're a fix and flip person, having a lot of wholesalers that know you, a lot of realtors that know you, so that they think of you first, so that you can keep having those leads come in. So that's one of the challenges with the fix and flip strategy, but it can reap a lot of benefits if you're well connected. There's more risk. You have to have more risk tolerance with fix and flips, because when you're fixing a property, you can expect the unexpected. My first flip, I had that same mentality, which I learned from Bigger Pockets podcast. Basically, expect things to go wrong and not be crushed by it. And it was great advice, because, and I like showing stuff with numbers. If that's okay, can I share a screen?
Yeah, go for it. Let's do it.
I like looking at Excel spreadsheets when I'm talking about. Let me see if I could find one that would be helpful.
Hey, I'm working on that one segment of my app where I can add fix and flip. So that's coming probably later on this year.
Is your app going to be for sale, or is it going to be something I could just like download?
Well, yeah, I think it's gonna be what I'm gonna do is, once I got it into a nice polished product, right? I'm gonna give it to you guys so you guys can play around with it. You guys can be my beta testers. Tell me what I need to do to improve it, but from there, I'm gonna take some of that feedback. I'm gonna set up a link or whatever, and whoever wants it, they have to pay for it to get the link to download it. So yeah, it's gonna be something like that. And starting off this year, I'm gonna put that link up.
Okay,
That's cool.
Can you all see my screen?
Yes,
I can
sir.
see it. Yep.
So what I have in front of me is a calculator that I made to make it easy for us to decide whether or not a property would be a decent flip or buy and hold before having to go look at it. All right, so basic information you can get off of Zillow, Realtor.com, whatever. The property was being sold for $39 and it was trashed, which, after we're done with this real quick, if we have time, I can show y'all some of the pictures. It was ugly. I think this property was built in like 1920 something. But anyways, and I think it was like a 3-1 and we made it a 3-2. $39K to purchase it, about $90K to rehab it. And then the predicted ARV after repair value based on comps, for those who aren't familiar with comps, comparables, basically finding properties are similar to the property that you're going to eventually want to sell so that you can have an idea of what it'll be worth. Typically, you want to have a very small radius around that place, like maybe a mile radius, property sold in the last 6 months that have the same square footage, bed, bath, everything is as close as you can. The more popular the area, the better your comps will be because you'll have more data points. Okay, so, right now you can already see that, just by these three numbers, asking price, rehab, and ARV, there's a predicted delta of about 30K if we were to sell it for what the value of it would be. Now, for those of you who are like me, that doesn't have $124,000 just sitting around to buy and fix up a property, you might say, well, Romain, how do I get started in real estate? How do I do a fix and flip without having $125,000? I'm glad you asked, random person.
That was me.
Yeah, I was saying that in my head.
Thank you. I used what is called a hard money loan. Hard money lending is, there are entities out there like Lima One Capital, who we use for this one, that they typically work with investors, and they will allow you to have what is essentially a mortgage, with a higher risk property. So typically banks will not allow you to use a mortgage on a dilapidated property because the dilapidated property is the security for your mortgage. So if you default, they get the trashed property. So they don't want that. But hard money lenders say, if you meet our qualifications, we will give you the loan. Those qualifications for this entity included giving them a statement of work that we believe will get the property to its ARV. They had to approve the statement of work. And what I got in return was they would pay for 90% of the project. So I said the purchase price and rehab was about 125. So that means 90% of that was a loan. I only had to pay for 10% to play. And you could do the math. So that means about 12K I had to come out of pocket to get this project to work. Right? Now, of course, just like with other loans, there are other fees. So there's origination fee, closing fees, appraisal to verify what they called it. They called it a subject to completion appraisal. So we're not saying what is the property worth now. It's what do we believe the property would be if you did all this stuff on the statement of work. My down payment, which was about 12. So with all that together, out of pocket 18K, right? Now you may say, oh, so if you actually sold it for that ARV, then you would make 30K and you spent 18K. That is a good return on investment. I think if you ask anybody, because you basically doubled your money. But like I said, fix and flips, that's good for raising capital quickly, but there's more risk, right? I could tell you that, and you can ignore everything under the green. In the green, this is what I use to determine if I wanted to keep the property instead of selling it. What could I rent it? Like, what would be my return monthly for renting? And based on leasing comps in the area, I would have been losing $200 a month. So it wasn't good. But for a flip, the predicted net cash after sell was actually 19, because one thing I forgot to mention is one of the consequences of using a hard money loan is they have a higher interest rate, 11.5% for this one. So you divide that by 12, multiply that by the loan, you can figure out how much you have to pay each month that you're holding the property, that you have to pay in addition to your down payment. So here, monthly hard money payment was $1,000. So my holding costs for every month that the property wasn't sold yet or it was still being fixed was $1,000 basically, which cut into my profit. Yeah, go ahead.
Yeah, I have a handful of questions.
Yeah, feel free.
Yeah, so first and foremost, I love this chart, and we should definitely reference it in future podcast episodes. But I did see you note the 70% rule, the 50% rule, and the 1% rule. And I wanted to get a little bit more insight into that. And then I do have one more question after you answer those.
Oh, great questions, man. Okay, so 70% rule, 50% rule, and the 1% rule are all rule of thumbs that can help you compare properties. And they're rules of thumb. There's exceptions to them. You don't have to use them, but I find them helpful for my brain. So in this case, the 70% rule is checking to see whether or not the price to purchase and fix the property is less than 70% of what it's worth after repair. The reason why that's important to me, if I wanted to BRRRR this property, which is a common phrase that I think was coined by Bigger Pockets, buy, rehab, rent, refinance, repeat. So the whole golden goose of BRRRR is you buy a property, cash, you fix it up, cash, the property value goes up. The money you spent is less than 70% of, and whatever, you could use 70, you could use 80, you could use 60. In this case, the money you spent out of pocket is less than 70% of what the property's worth after you fix it up. So then you go to the bank, who will now give you a mortgage because your property is brand spanking new. It looks beautiful because you fix it up, right? Then you say, hey, I want to do a cash out refinance. And they're like, oh, well, that's great, Mr. Scoffrey. We'll give you up to 70% of the equity in cash. So guess what? Now you have this beautiful property that you just fixed up. They gave you a mortgage that was pretty much equal to what you spent to get it there. And now you walk in to a property with the, let's say in this case, 120K. And if the ARV was more than, if the ARV was a little bit higher, you would buy a property, fix it up, rent it out. And now you have all your money back to go do it again. And that's why it's the golden goose, because you get to escalate quicker if you can just cash out, refi, so that you get your liquid cash back.
That makes a lot of sense.
Cool. All right. So 50% rule. So 50% rule is helpful in renting or determining if a buy and hold has a good chance of being successful. The 50% rule is assuming that half the rent that you can get for that property will be used for operating expenses. Operating expenses do not include PITI, your principal, interest, taxes, and insurance mortgage payment. So if, let's say, I could rent something for $1,000, I'm right off the bat saying to myself, okay, half that is going to be gone to just keep the property management fees, capital X, saving for a new roof, saving for a new water heater, whatever. So with the remaining 500 is my mortgage payment. What's my mortgage payment? Let's say my mortgage payment was $400. Then using the 50% rule, I'm predicting that I would cash flow $100 positive, just using the 50% rule. If I use the 50% rule and I'm way not even close, then I'm saving my mental capacity. And I'm like, you know what? I'm probably not going to dig any deeper on that. It helps you screen out a lot of bad investments. And then passing the 1% rule, and a lot of times people use the 2% rule. It's whatever you want to use. But it's basically saying if the property can rent for at least 1% of its market value, it's probably going to be a good investment. So if the property is $200K, if you could rent it for at least $2,000 a month, then it's probably going to be a good investment. One thing I learned from doing this flip is I need to have my statement of work and I need to add like a 30% buffer on it. Just multiply it by 1.3 and just say, I don't even care. I don't care what you say that you think this statement of work is robust and it covered everything. I'm adding 30%. And if it ain't working with 30% more, then I don't care. Because in this one, we found out after we had already got the statement of work approved that the roof on the detached garage needed to be replaced. And guess who had to pay for it?
Oh, no.
Oh, man.
Oh,
we had to
man.
gut a bathroom because we found out the bathroom we were going to keep in that detached area didn't have a link to the main water line in the house. So we just whiteboxed it, took the tub out, the sink out, all that.
Jeez.
Guess who had to pay for that?
Oh, man.
Jeez.
So that 30% is my learning lesson learned from a flip.
And you know what they say about wisdom is you learn from other people's experiences. So
Serious. Serious.
So
This part of the podcast was gold.
so you had another question about the 70%?
Yeah, actually, it was you talked about the cost of holding, which I thought was really interesting, right? So you're not just talking about purchasing the property, investing money into it to bring up its value, but you're talking about how long it's going to be on the market and whether or not you're going to rent it or whether or not you're going to sell it. So there's a duration aspect in this calculation as well. So right now, what you talked about were very finite point of sale type numbers. Can you talk a little bit about like what is your duration? Like your holding cost is $1,000, and that seems pretty high to me. Does that mean that you're going to go 2 months and then you got to figure something out? Like, what does that look like for you?
Okay, so this property was bought in December of 2019. Our statement of work predicted that everything would be done in 3 months, knowing that each month I'm paying, that 11.5% interest on that 90% hard money loan. Even with that 3-month expected rehab duration, I was still well in the black on the predicted profit if the ARV is what we expected of 158.
Mhm.
Now, guess what happened in March of 2020? We had a very interesting global pandemic where my target audience for this property, the target, what do they call it? Class, lower middle class, were all like, we don't know if the world's ending, so we're going to hold on to our money. So my property was on the market from March, I think, to like July. So that was another $4,000 and that we were losing with the property just on the market.
Wow.
It was ready to go. It was on the market, incrementally changing the asking price to see how many people come look at it and whatever. And I had to do my closing where I handed the keys to the new, I think they were newlyweds, and I was very happy to sell it to them. But I had to do a, what do they call it? Remote closing, where I was sitting in the driver's seat of my car and they would come to my window with my papers to sign. And I'm just like, all right, can I get some fries too? Like, it was a very neat experience.
Oh man, that's
So
wild.
if you don't have any more questions on the fix and flip, I can go into a buy and hold that I analyzed yesterday that I'm actually getting ready to tell a realtor I don't want. So this is actually perfect timing because I spent like 3 days looking at a property.
Oh, snap. So this sounds serious.
It's hot off the press. I can share with you this one here. I really wanted it, guys. And Travis was hitting on, and maybe he didn't use the word emotion, but
Subjective.
like,
subjective decision making.
The impact of non-objective decision making. When you're like, I really wanted this property. I tell you guys, I really wanted it. So the scenario is this. It's a guy who's retiring and he's liquidating his portfolio, and he happens to know the property manager that manages my properties. So he didn't even put the property on the market yet. And based on my response, which will probably be, I'm not interested soon, probably tomorrow, he may go and put it on the market. And that hurts because I really wanted this property. I walked it on Tuesday and met the tenants. Like, they're already there. One's been living there for almost 9 years. One's been living there for 3 years. It's right between 2 parks that I used to train for marathons in. It's a nice place in a nice neighborhood. All the schools are 10 out of 10 on Zillow. Like, it's nice. Now, taking the emotions out of it, let's look at the data. He wants $188,000 for it. Each side is renting for $800, so that means $1,600 total. Now, what rule does that violate already?
The 50% rule.
Yes. What other rule?
1%.
1%.
Exactly. Right. So the predicted mortgage payment. So I talked to my lender right now for investments, and this is one of the cons of using and not doing live-in flips. I can't do less than 20% down, right? So 20% down for this, and I'll zoom in because I know this is probably really small on the share. All right, so I made 3 different scenarios here. The first scenario is if you only change the rent that we can rent it out for. The second one is only if we change the purchase price, which we were unsuccessful in getting the guy to budge. But I tried to sell my case, bro, and I'll tell you what I said. And then on the third one is if we change both the purchase price and the rent together. My lender and investors, be careful, because your lender wants you to buy. So what they'll do is they'll ask you, and he asked me this, what mortgage payment do you want to get your desired ROI? I said, I can calculate that. If we kept the down payment the same and the closing costs the same and the points that I don't want to pay on the interest rate the same, I would want my mortgage payment to be less than 1010. He's like, okay, I'll get back to you. 2 hours later. Oh, I calculated, to get you to 1010, you would have to put 50% down and buy 2.5 points. I said, no, I told you, I'm not trying to put more down. I am not trying to have all my money sitting here because I don't care about the mortgage payment. What I care about is the ROI. So let's look at that. And I was about to get hot because I'm like, bro, I told you before you even started calculating. All right. I know I can't get something for nothing. Right. The denominator just got bigger. So my ROI got smaller. So anyways, the guy wants a 188 rigid down payment. I want the minimum amount of money that I could put in the property to acquire it because I want to have money set aside to fix things and also buy other properties. So down payment, 20%. My mortgage rate, based on my credit score, based on it being an investment property and not a home that I'm living in, that's what I'm working with right now, 8%, because the market is crazy. Closing costs, about $3,500. Property tax in this area, 2% of purchase price. Home insurance, estimate about 0.6% of purchase price. PITI, 1510. 50% rule, I need to be less than $800 on my mortgage payment to cash flow with the 50% rule. This is almost equal to what I would be getting in rent. That's not less than half. That's almost equal. Right now, I also have to pay my property manager. He has this rate of 10% of what I make on rent or 75, whichever is more. So 160, right? So I would have a negative 2% return on investment annually if I bought it the way the situation is.
I do have something for you after you finish this.
Okay.
Another scenario.
Okay, sweet. All right. So then I went to Rentometer because my property manager said he couldn't find any worthy comps on the leasing. And I said, okay, for this property, it did a smart radius, which basically it tried to find a radius where you could find comparable properties. It said based on 6 data points of 2 ones in the last 12 months and a 10-mile radius, which is huge. You want it to be small as you can. Average rent, $1,100. 75th percentile, $1,200. So it would be reasonable based on that data to not be making $1,600 in rent, but making $2,200 in rent. Now, one challenge though with the buy and holds is I have 2 tenants that are loyal tenants. If I raise the rent too fast or at all, I could lose those loyal tenants and then have to be paying all this myself. So that's another risk. If I do it too slowly, then that just increases how many years, because you would only increase it probably on each renewal of the lease or if a tenant leaves. So then that increases the number of years that I'm in the negative, right? So that's one thing to consider. But I said, if I did increase the rent all the way up to $2,400, and these are in equal increments, there is a place where if I bought it for the price that he asked for and kept everything else the same, where I would start getting around my target ROI. So there's a potential there. Now, before I move on, Ron, was there something you wanted to say on that one before I move on to the next one?
So I think the issue is how you're trying to finance the deal. And I don't know if this is a question that he might take up, but he is liquidating his portfolio. But essentially what I'm suggesting is probably get back to him on some creative financing stuff, right? Where you take the bank out of it entirely. He want his number.
Seller financing.
Yeah. Exactly.
So I brought that up.
Oh, so
Yeah.
all right. So what he said.
No. Hell no.
Well, what were the terms?
Seller, because for those who are not initiated, seller financing is where basically you give your down payment that you agree to with the seller and whatever payment rate, how long and how much money each month, you basically say, I'm going to give it to you. Don't even need the bank. And maybe if they're okay with not getting their lump sum that they would get if you use the bank, because they would come out of the closing table with $188,000 minus the commission for the realtors. And I have to convince this man who is done. He is ready to go to Italy and just hang out and say, hey, man, would you help me out and just take maybe 20% of that and then actually let me pay you? Actually, let me sweeten the deal. Instead of 20%, maybe I give you 30 or 40%. And then I pay you the rest with like a 5% interest rate. Win-win solution, right? Nah, because he wants all his money now. Other people might be willing to do that depending on their situation, but this guy's not. And believe me, I wanted this property. So I was like, yo, I even tried to challenge how he came to the 188 because I said, okay, what comps did you use? The comps that he used, in my opinion, are erroneous. He only had 2 comps that were sold in February of 2021 and June of 2022. Now, I'm not going to switch pages here because of the whole click and sharing things, but I went and researched the past 30 years of mortgage rates. In the last 30 years in America, we have had record lows in mortgage rates. In 2021, the average was 2.96. And then in 2022, it was 5.3, I think. But the 30-year average is 7.75. So he is using comps where people had so much more buying power 2 years ago and a year ago than I have now, because the rates now are almost triple what it was in 2021 and almost double what it was in 2022. So I was like, hey, man, now I had to go through my realtor because, protect him, because I was about to just negotiate like crazy. I was like, hey, man, even if I don't buy it, you might not be able to even get what you're asking for from someone else. I'm willing to pay you close to what you're asking for, knowing that if you put it on the market, you may find that no one's willing to pay that much because of the buying power is so much more reduced because of how quickly the Federal Reserve has raised the rates. But that didn't fly either.
And this might go into this whole thing, but like, you've seen Shark Tank. It's like, oh, you don't want to make this deal, man? Like, I'm giving you exactly what you want. All right, don't come back to me later on when you want to make this deal now. And yeah, like exactly what you're saying is like his comps are erroneous. Is like it's going back to during a time when buying power and money was super cheap. They don't put his stuff on the market. Let him wait, because he's not ready to have that discussion. He is looking at those comps. He is thinking that, hey, Midwest is pretty stable. So the values that it did jump up during that time is going to be stable. That's what his thinking is, like, from my standpoint. But let those properties sit for a couple of months when you put them on the market. He's going to have a whole different mindset.
And who knows? Who knows? There may be an investor who's okay with not having a cash on cash return on investment because they're willing to just have the property for the long term when the mortgage is fully paid off, or they have the cash to just buy it straight out. Just 188, boom, I got you. And they'll just be collecting rent. Their ROI might be trash, but they don't care because they know that this property, people are going to be living in it forever because of the wonderful school zones. And that area is growing. I used to live in that area and I know it's growing, but it depends on what the investor's goals are. Like Travis said earlier, and my goals, I want to average around 10 to 15% ROI, and I'm not getting there with this situation. And then I showed my realtor and property manager and my lender, basically, even if we did get him to change the price down, set 18 grand, which would be unrealistic. If we didn't get that rent up, then the ROI still wouldn't have a substantial change.
Yep.
The flexibility, the dependency is far more on the rent than the sell price.
So it's definitely a curveball, and Ron, let me know if this is something that you want to dive into in another episode, or if this is too far off course. But Rocky, you talked about ROI a bunch, right? And I think that the difference in the strategies that we've talked about today is really around time, right? So if you're going to buy and flip, that's immediate capital or immediate cash flow, right? You're getting your return right now. If you stay in a property and you rent, if you keep a property and you rent it out, that's long-term wealth, right? That you can continue to invest in, and you're going to get the equity out of that as well. but we're talking about these ROI numbers of 10% that you mentioned, and I'm curious if either of you heard about REITs, and if you have, what are your thoughts on if you should go ahead and invest in a REIT, or if that's just not for you?
Yeah, I have because this is going to some stock stuff, which I definitely love to talk about. So yeah, with REITs, right? So essentially, I forgot what it stands for, but essentially it's like real
Real
estate.
estate investment trust.
Exactly. Yeah, exactly. So pretty much it's like a company that holds a bunch of properties for you, right? You invest into it as if you're doing like a EFT or something like that, or stock. Buy a couple of shares in there. The benefits behind it is that you're guaranteed, like REITs have to give dividends out in their trusts, right? In their fund. So, you get that, right? You get a guaranteed dividend percentage, and some REITs, range very drastically, but you have that and you don't have to deal with any headaches of a property. The only thing is, right, you don't get any of the appreciation and the tax benefits with a REIT that you get with actual physical real estate.
And if I can add to that, so there are some pros that are probably less financial to buy and hold that I like to share. So for me, compared to a REITs, or I would, I look at those as like stock except in real estate. I like looking at the world like it's a monopoly board. So I like having more cards. I like having more deeds in my drawer. I like driving by a property and saying, "Hey, son, we own that." He's like, "Well, who's that person that's living there?" I'm like, "I don't know. I never met him, but that's ours."
Yeah.
Right. Um, there was a strategy that someone shared with me that changed my whole mindset. It's similar to how Robert Kiyosaki talks about in Bigger Pockets about the mindset of, oh, go to school, get good grades so you can get a good job. Where he says a rich person's mindset, they go to school to learn what they need to do so they can make jobs for other people. With the buying of a property, all the flexibility that it gives you when you hold it, you can appreciate with it. Then there's the debt pay down. That's the second way you build equity or build net worth with it. And then the third is cash flow. So those three things are working in concert with one another to build your net worth. And then if you have a property, let's say you have a child who I heard on a podcast someone say, instead of paying for college savings plans, which are basically like retirement accounts, they're just dedicated to savings plans to college. They said they bought a property in their kid's name. The property appreciated for 18 years. The kid said, "Hey, I want to live and go to this local university." They're like, "Okay, do you want to stay in this house rent free? It's yours." They're like, "Oh, nah, I want to go to UF because it's the best school in the nation." And it's like, okay, well, you can sell this property and pay for all your room and board and tuition for as many years as you want to be there. Or if you got a scholarship, okay, great, Ron, you got a scholarship, go to UF, keep the property, and we'll rent it out, and they'll be paying you so you can have whatever groceries you want. I'm like, all this stuff you could do with just a physical piece of land that's yours, and then the improvements on top of it, right? There gives me a sense of pride that's like, this is stuff that you're leaving a legacy. And that is kind of intangible that I think is a benefit from buying and hold. You have something that you can give to your children and their children that no one can take away. You can transfer it. You can consolidate a whole bunch of properties and get an apartment complex, and then say you could put a big Trav on there and say, "Hey, this is the Trav Apartments," have somebody do maintenance for you and they get to stay in it rent free. So now you got free maintenance. Oh, you got too many apartment buildings, consolidate, get you an office park, call it Ron Enterprises. Oh, you don't get it done in your lifetime? Okay, well, no one can take it because you put it in a will to give it to your children. And then they're like, okay, well, dad didn't get it done in his lifetime, but that's okay because no one can take it from our family. So now we got a tower in New York.
It's a good point. It's a great point. I think what you call out is very inspiring, and I think it takes a mindset shift, right? Like you mentioned, getting a piece of advice that kind of changed the game for you. Um, I think when we started this episode, we talked a lot about barrier to entry, and we talked about how do we start getting to that point where we can start making these larger decisions, right? Buying the first house, in my opinion, is kind of that's the big hurdle you have to get over. And then it's about being really smart about how you invest after that, right? Because you can use the first house as leverage. So this idea of kind of setting your budget up in such a way that you have savings, you have a certain percentage for savings, you have a certain percentage for investment, and you have a certain percentage for your living expenses. And understanding how you can use the investment portion in a bunch of different creative ways to set up that legacy is important. I think I brought up REITs because going back to barrier to entry and return on investment and thinking about just numbers, if someone has $300 a month, like they've budgeted themselves in a way that makes sense, they're at a good financial state, but they don't have either the 20% down for a property, or they don't have the 5 to 6% down for a first time home, and they don't want to get into the process of loving a home and having to make a decision as to whether or not you're going to leave it and so on. There are lower cost opportunities to get you started, to get you to that point where you have the capital to start making those legacy leaving decisions, right? Mm-hmm. And things like index funds and REITs. And I say REITs, I could have said index funds. I say REITs because we're specifically talking about real estate. But I'm thinking about what are those options, because where we are right now, where all of us have an initial property and we're investigating secondary properties or tertiary properties, that took planning and being an engineer, right? Like at least making engineering money. So
and having a spouse that's on board.
Exactly. Right.
Oh yeah.
if your family's not on board, it's not going to work.
It's not
so tough.
Picking up and moving my family was probably the easiest amongst the three that's on the call right now. It's just me and Angelica and our pets. Getting up and moving an entire family of 2 to 4 kids is something that's probably insurmountable for a lot of people if they want to get into trying to get into that first time homeowners like pocket. It's a good pocket to be in, but it's really stressful. Yeah. So, I wanted to bring that topic up because it is a lower barrier to entry opportunity for folks to get started, and then they can start making those bigger decisions and probably download your spreadsheet, Rocky, and be able to stick in the objectives train of thought.
Ron, I think I could talk a whole nother hour on savings. So let's put that as an option in the future, because I love talking about how to get from. So my wife and I, and this will be a preview, my wife and I graduated with over 120K in student loan debt. And to God be the glory, through different things, budgeting, a lot of husband and wife conversations, using one car and dropping her off at school and me going to work, and the car being paid off and having $50 of allowance to go to the movies and get a couple Subway sandwiches, to all the blessings that we're talking about right now. It didn't happen overnight, and I understand that we are privileged to even have this conversation. But when we talk about ROI, then I'm glad he brought up REITs. I would say there are a lot of different things that we could talk about that most people have in front of them that are like free money. Not free money, but like they give you a good return on investment. So company matches on 401ks, HSAs, tax credits on college savings plans, things like that, where you have a guaranteed ROI. And then we could talk about loans and how that's guaranteed ROI. I look at loans like they're investments, because for every dollar you put to that loan that has a 6% interest rate, you're saving 6 cents. You're giving yourself a 6 cents raise if you pay off a loan or a debt. Not 6 cents. If a debt has $60 minimum payment and you pay it off, you just gave yourself a $60 raise
Mhm.
or for that month times 12, $720 raise that year, whereas we fight tooth and nail to get our companies to give us a raise of $2,000, maybe that gets taxed after that. So yeah, we could talk about that.
Oh yeah. No, that's gonna be a great topic. And yeah, like learning what it takes to get to that point where you can actually invest into a physical property, like setting yourself up for success. And that's gonna be, yeah, definitely a very important topic. And more likely that is gonna be the next topic, because I really like that, because it was also Bigger Pockets book that I read, and that's the first thing they went into. What's your save rate? What's the amount of money that you have to actually invest into a property? Do you have an emergency fund just in case something doesn't plan out? Like, do you have reserves? And those are very important topics to talk about. And I think we should definitely look into that for the next topic, next episode. We're gonna conclude this with where are your goals for next time, and just a goal. And I'm going to start off with Travis.
My goal for next time is to have a better spreadsheet than Rocky.
Okay.
I don't know. I mean, to be completely honest and serious, my goal for next time is to make sure that my budgeting strategy is laid out in a spreadsheet so that we can very meticulously pour through it.
All right. What about you, Mr. Romaine?
I have so many spreadsheets. I would have to pick which one of what year. But I would say my goal for next time is to reflect on, just the blessings that I've been given, the words of wisdom that people have shared with me that they didn't have to, and try to give it to whoever this audience is, because it's life changing. The people who have poured in us so that we can even have the chance to have this conversation, the people who've died for this, right? It's humbling. So I don't want to waste that opportunity.
That's nice. Very great. And for me, it's a good question. Let me see the next step thing. My previous one was to analyze a whole bunch of deals that I had set for per week. But this one, I'm gonna try to get creative with a deal. And I didn't really get to discuss it this time around, but I'm gonna get creative with how I structure my deals next time. So I'm gonna see if I can structure a deal, and even if they say no or yes, I'm just gonna put it out there with my creative finance deal. All right. Well, thank you all for coming here. Thank you very much. And as you know, this is the High Podcast, and I'll see you guys next time. Peace.
All right. See you.
Take care, y'all.